How to day trade without blowing up your account. Your cursor hovers over the sell button while a 5-minute candle squeezes into a tight coil under yesterday's high. Level 2 flickers with spoofed size, bids flash then vanish, and your stop loss is a thin grey line you promised. Promised? You wouldn't move. The P&L panel blinks green then red, as if the platform is trying to teach your nervous system Morse code. You can feel the dopamine tug when price ticks in your favour, and the cortisol stab when it ticks against you. Your breathing shortens. A new 1-minute bar opens, the wick snaps down to your stop. You feel the adrenaline and nudge the line lower, just this once to keep the position alive. In 2 moves you've turned a trade into a prayer, the next print hunts your new stop anyway, and you're out, then instantly angry. Chasing a revenge entry at market, deeper in drawdown. You tell yourself it was the algos, but the truth is simpler. You traded your brain chemistry, not your plan. Most traders lose money. Say it out loud because you aren't exempt just because you read charts on TradingView and know what RSI divergence looks like. An account blow-up rarely arrives in one dramatic candle. It's a slow leak of micro-disqualifications. An entry taken for fear of missing a breakout when volume doesn't confirm. A stop nudge during a wick. A scaling decision that doubles risk because the last trade was green and serotonin had you feeling invincible. The platform is neutral, your interpretations aren't. Candlesticks are random over small samples, and yet the brain is a world-class pattern machine. See 2 similar bars. Your mind hallucinates a setup that must work, and you pull the trigger to relieve tension rather than to exploit edge. When you trade to relieve tension, you're paying a hidden fee, your future freedom to execute when it actually matters. Here's the behavioural trapdoor that opens beneath day traders. Entry hesitation paralysis makes you late. You buy where the reward/risk is worst, so you tighten your stop to make the math pretty. Tighter stops get pinged more. You absorb the sting by removing the stop altogether. For a second, stop loss removal syndrome, only to discover that price can travel farther against you than you can imagine. When you finally close, the pain flips to anger, and anger flips to action. Revenge trading loops. Overtrading compulsion follows because the only way to make the P&L feel better is to trade more. Each loop trains your nervous system that impulsivity is how we enter discomfort. Congratulations, you've built a habit. Past patterns don't guarantee future outcomes, they guarantee future urges. Neuroscience isn't a sideshow here, it's the show. That green flash in P&L is a dopamine micro-reward that reinforces whatever preceded it, even if what preceded it was sloppy execution. Red prints spike cortisol, narrowing your attentional field so you miss order flow cues on the tape and the volume profile that clearly shows acceptance below your entry. During fast volatility, adrenaline floods and your time perception compresses. You think you're scalping with precision. Really, you're clicking to make the adrenaline stop. After a multi-loss streak, serotonin depletion leaves you pessimistic. So you cut the next winner short to lock it in, encoding exit greed extension. The illusion that more clicks equals more control. On social platforms, mirror neurons sync you to other traders' excitement. Their conviction feels like your own. None of this is your fault, and all of it is your responsibility. Here's the paradox of trading that ruins careful people. The best trades often feel uncomfortable at entry because uncertainty is properly priced. The worst trades feel delicious because they scratch your itch. Perfect setups fail often, especially when they're obvious across every time frame. More analysis can make you worse by pushing you to justify action that isn't there. The tighter your stop, the more the market will teach you about microstructure the hard way. More screens, more indicators, more alerts can deliver less clarity. For you, Mum, the work is to tolerate uncertainty in the moment and seek certainty in your process before the moment. Risk management is survival, not style. It's the only thing you control when everything else is moving. So how do you day trade without blowing up? Start by accepting that your job is not to be right. Your job is to define risk. That sounds cliche until you audit your last 50 trades and realize you were defining reasons. If you do nothing else, build a rule set that makes it physically hard to break your own guardrails. Platform rules, not just promises. Hard-coded stop orders, not mental lines. Max daily loss that flattens all positions and locks entries for the day. A position sizing table that maps risk per trade to market conditions and your current drawdown. No exceptions written into the rules. Exceptions are where liquidity hunts live. You can't out-discipline chaos with willpower. You out-engineer it with constraints. Picture Marcus at the open. He's a risk manager archetype. Two 27-inch charts. Left is trading view with the 1 minute, 5 minute, and session VWAP. Right is a depth of market ladder with order flow and a rolling delta pane. Above, a 30-minute view marks overnight high-low, prior day value area, and a simple moving average stack to define trend context, not entries. Before cash opens, he tags 2 or 3 zones where liquidity is likely to do business. A prior session's point of control, a clean breaker block, a supply shelf. No predictions, just contingencies. He writes a 1-line thesis per zone. If price tests yesterday's high on rising cumulative delta and holds above VWAP on a 1-minute higher low, I'll take an entry with stop 2 ticks below the failed push. For the short, if we spike into the overnight high and delta diverges on falling volume, I'll fade back into value with a stop above the spike high. These are not poetry lines, they're executable logic under stress. The bell rings. Marcus takes his first trade only after the 5-minute bar closes inside his plan. Sizes preset by risk per trade, not feeling good. He places the stop where the setup is wrong, not where it is comfortable, and he doesn't move it. His bracket order includes a partial at 1R to pay risk, and a trail that engages only after structure confirms. If price instantly tears through his stop, he does nothing for 1 bar. Breathing protocol. Inhale 4, hold 4, exhale 8, hold 4. It's not woo-woo. It resets his CO2 balance and widens attention so he can see tape behaviour instead of his heartbeat. A second setup appears. He takes it if the confluence is present. If not, he logs why he passed. He does not earn points for activity, he earns points for following risk. Marcus has a wall of small practices that look boring and keep him funded. He reviews 30 screenshots of yesterday's A+ setups across different timeframes to prime pattern recognition. He labels the market regime trend, balanced, volatile, balanced, because your strategy is a function of environment. He runs a 2-line pre-mortem. How will today blow me up? And what single thing, if avoided, keeps me green? He sets a daily trade limit. He uses a cooling off protocol after any 2 consecutive losses. Stand up, step back, 20 squats, sip water, touch a doorknob. Reread the plan out loud. He ends red days at his stop. He ends green days before tilt. He acts like someone who knows that compounding is not just for capital, it's for discipline. The biggest money leak for day traders isn't the first loss, it's the second, third, and fourth that follow the emotion of the first. Build a circuit breaker. Hard code it. If your max daily loss is 2R, the platform flattens and disables trading for the session at 2R. A lockout isn't punishment, it's capital preservation. The trader who survives can learn. The one who blows up becomes a cautionary tale. You can lift your circuit breaker on sim to satisfy the impulse to click. But your real account is not your laboratory, it's your oxygen. Risk management is survival. Let's talk entries and exits, because don't blow up isn't a moral slogan, it's execution detail. Your setup isn't a picture, it's a process. Define the context, higher time frame structure, the trigger, lower time frame signal, and the invalidation, where the premise fails. If your entry chases through the spread on a 1-minute green bar that closed at the exact prior day high, but the 5-minute shows exhaust and cumulative delta is diverging, you didn't enter your setup, you entered your fear. Waiting for confirmation isn't late if the confirmation increases your probability enough to offset a worse price. Trade location beats prediction. And stops belong where the idea is wrong, not where you like them. If that makes position size too small to matter, that is not a hint to move the stop. It's a hint to skip the trade. For exits, pre-commit to 2 paths, structural and statistical. Structural exits trail under higher lows in an up move or above lower highs in a down move. statistical exits trail behind a multiple of ATR on your entry time frame. Never use your P&L as a take-profit signal. P&L is a mirror, not a map. The mind loves to cut winners short when serotonin is low and loves to hold losers when cortisol is high. Outsource both decisions to rules and alerts. If you must scratch early, require a market-based reason. Failed retest, delta flip, volume rejection at your level. It felt like it would turn is not a reason, it's an admission. Your journaling's a weapon if you wield it correctly. Don't write novels, write truth. Use a template that captures setup tag, regime, entry reason, stop location logic, risk size, adherence score, and a one-line post-trade verdict. Kept stop intact. Exit was P&L driven, FIC. Each weekend, run a simple query. Which tags are positive expectancy? Which tags fail in which regimes? You are not a generalist, you are a specialist in 1 to 3 repeatable situations across specific time windows. If your A+ only shows up 3 times a week, good, that's enough. Overtrading is the disease of traders who never defined enough. There's a dangerous seduction in day trading, the belief that more information equals more control. You add indicators, screens, and Discord rooms until your attention is shredded. The pros are boring. They strip down to price, volume, a few moving averages, VW up, delta, and context. They respect level 2 for its games and never forget that most depth is theatre. They consult volume profile to see where business was done, support resistance to see where memory lives, and order flow to see who is actually pressing. Then they accept the day's character. If it's balanced, they fade edges with tight risk. If it's trend, they stop fading and hitch rides on higher-low pulls to VWAP. They don't force strategies into regimes where they don't belong. The market doesn't care what you like to do. Let's diagnose the costly pattern all blow-ups share. It starts with the equity curve going up, then flat, then the I deserve to size up thought. You double risk without doubling evidence, catch 2 losers, and feel compelled to make back quickly because identity is on the line. You shift timeframes midday, change symbols, add a scalping tactic you haven't tested, and before lunch your brain is in survival mode. That's when the stops move and the swing trade, just for today, appears in a day trading account on margin. This is how accounts explode, not from a bad trade, but from a series of rule breaks justified by the feeling that you're different today. You're not different today, you're human today. Marcus avoids this spiral with a few non-negotiables. He cannot increase size unless the last 20 occurrences of a setup are both profitable and executed without rule breaks. He cannot trade a new instrument live until he has 50 sim trades logged on that instrument, with the same platform hotkeys, same brackets, same hours. He cannot remove a stop at all because his platform doesn't allow it. If he wants to widen, he has to flatten and re-enter, which forces a redecision instead of a reflex. He has a last loss ritual. He writes the specific mistake on a sticky note, puts it on the monitor for the rest of the session, and gets paid in shame if he repeats it. It's not about guilt, it's about friction. There's also a pre-market routine that rewires impulses. 10 minutes of if-then rehearsals. If price rips through my level without a pullback, then I do not chase. I set an alert for the retest. If I'm down 1R, then I take a 5-minute break and lower size by 50% for the next trade. If I feel the urge to move a stop, then I close the DOM, look at the 5-minute and ask, has the premise changed? If no, the stop stays. He anchors this with breath and posture, so the ritual is somatic, not only cognitive. By the time the bell rings, his brain has a playbook that competes with the limbic system. He's not trusting discipline, he's training it. This is not financial advice. Nothing here promises profits. But it does promise fewer catastrophic outcomes if practiced. The stats are ugly. The majority of day traders will lose. Many will quit within a year. A non-trivial share will experience a 50% plus drawdown at least once. What separates the minority that survives isn't secret alpha. It's the boring, mechanical, almost rude insistence on treating risk like oxygen. They accept that you can't predict the next tick. You can enforce your next action. They accept that probability means streaks. They design rules that keep them solvent through streaks. They accept that skill is pattern recognition. They train that skill with screenshots and post-market review, rather than with dollars at risk. There's one more paradox worth holding. To trade like a pro, you must agree to feel like an amateur. Often, the market will make you uncomfortable at the right moments. Your best entries will rarely be reinforced by Twitter cheers. Your cleanest fades will happen when chat rooms are chanting breakout. The work is to anchor your identity, not in being right, but in being robust. Robust means your worst moment is capped, and your best moment is allowed to breathe. Robust means your average day is boring, and your bad day is survivable. Robust means you can miss the move and still be fine, because your account, your rules, and your mind are intact. Imagine, weeks from now, a day where the open trends cleanly. Price pulls to VDA you up at your trigger prints, and you click once. No hesitation paralysis, no extra confirmations to soothe fear. Your stop is in, you pass 1R, scale a third. And trail structure. Price grinds, you do nothing. It spikes, you do nothing. It rolls, you exit because your rule told you to, not because your P&L begged. You log it and step away on time with mental energy left for your life. You didn't blow up today because you never gave yourself the chance. Not because you were perfect, but because your system didn't need you to be. That's the path. Make your trading small enough to obey your rules, and your rules strong enough to survive your worst urges. Define risk before you define opinion. Accept randomness in outcomes and reject randomness in process. Cut your losers at the level where your idea is invalid, and let the occasional winner express itself without your constant interference. Build constraints that execute when you cannot. Trade the plan in front of you, not the feelings inside you. That's how you day trade, without blowing up your account. And if you forget for a moment, your platform won't, because you taught